And joining me now is our expert, Joe Brusuelas. He's a principal and chief economist at RSM US. Joe, always a pleasure to have you, especially as we look to start 2025.
Yeah, so you know what? I think we're going to have a pretty good economy. It's got a real tailwind heading into the new year. So our forecast, our baseline forecast, which we attach a 55% probability, is the economy is going to grow at about 2.5% next year with risk to the upside. We're expecting 4.2% on average for the unemployment rate. We expect about 120 to 130,000 jobs per month to be added. A little bit slower than the pace we're used to, but that really accounts for where we're at in full employment. Now, on the financial side, we do expect the U.S. 10-year to average 450 over the year. Now, that means we're going to trade between 430 and 470, but there is risk to the upside, and we do expect forays even above 470 towards 450 due to the underlying strength. Now, here's something that's real different compared to past years. For the first time in several years, the alternative to the baseline is not a recession. It's actually that the economy will grow at a 3% pace or greater. Now, what that means is that those 50 basis points of Fed cuts that we've all priced in for this year, that would not happen as we expect in our baseline forecast.
Interesting.
That means inflation's going to be a little bit stronger. In our baseline, we're expecting 2.2. Now, if we get 3% or above, you're going to see above 2.5% moving towards 3. Now, that's a very different situation than where we're in. And I think it's also important to remember that the long-term growth trend in the United States is around 1.8%. So neither our baseline or our alternative to the baseline, we're growing well above long-term trend. This is the economy we want, and this is the economy we need. And I want to be clear here. The only thing that we've priced in is that the 2017 Tax Cuts and Jobs Act is going to be rolled over. That forecast was not attenuated to any tax cuts that come with that.
Interesting.
Right, or any real relaxation of deregulation. So I do want to call out that alternative to the baseline.
Interesting.
We could get, if they get their stuff together in Washington and get things done early in the year, second half of the year could see very strong growth.
What does that mean for the stock market?
Okay, so I think what that means is that we all look at leverage. As a matter of fact, Kristen, my word of the year for 2025 is leverage.
Interesting.
If you looked at the Fed's minutes from November, you saw the word leverage mentioned 7 times.
Wow.
That doesn't have anything to do with the election. It's just we can see conditions coalescing where risk appetite is building.
Yes.
The proxies for leverage all have different credit spreads that we look at are all at or near all-time lows.
Interesting.
With the relaxed regulatory environment, you should expect risk appetite to build, deals to happen, mergers. This to me bodes well for the stock market outside of the Magnificent Seven or tech industry, which is almost its own separate universe at this point. So that is very optimistic, I think, and we should see a pretty good year in equity valuations in 2025.
I'm curious, Joe, in terms of the rate cuts. It sounds like based on this forecast, no rate cuts are what you're predicting for 2025.
No, we were predicting 50.
You were predicting 50.
Yeah, but if this economy takes off, then we're going to maybe see no rate cuts. As it is, I don't think we even get the first chance of a rate cut until March, and that may be a little bit too optimistic at this point, given the tailwind behind the economy.
You noted that this is the economy that we need.
Yeah.
Expand on that.
So what's driving growth? Okay, it's household consumption, low unemployment, modest job gains each month, but most importantly, wage gains have been above inflation for over a year and a half. We're going to see a pickup in hiring and probably a pickup in wages. That's the first thing, right? So that's organic, that's good. It's sustainable under current conditions. Second, businesses are investing in themselves. We talked about the tech sector, NVIDIA and its ecosystem. Okay, firms are buying these chips because they intend to boost output in a cost-efficient way.
Joe, let's pause that thought for 1 second. NVIDIA is such a hot topic, but we do want to turn to the opening bell. Joe is going to rejoin me here on set after the opening bell to talk more about this economy. Let's take a look at the podium. Rejoining me now is Joe Brusuelas. He is a chief economist at RSM US and breaking down everything we need to know about the economy as we round out 2024, enter 2025. And Joe, just before the opening bell, you were noting NVIDIA and what you're seeing in the pipeline there. What more can you tell me about NVIDIA?
All right, so NVIDIA has become a critical component. The company's almost too big to fail now, right? Because the firms are all integrating that sophisticated technology into the production of goods and the provision of services. We're seeing an increase in productivity. That creates conditions whereby these valuations can be validated. But this is the year we're going to need to see it. So those things that are driving the economy, household consumption, fixed business investment and productivity enhancing equipment, software, intellectual property. And then finally, there's a pretty big fiscal tailwind. Of course, those chip factories are going to come online this year. 2025 is going to be a very heady year for this economy. It's almost like we're going to pivot into this different world where we're going to have to prove it. You know, those valuations at NVIDIA, the government money that's been sunk into building those supply chains around those sophisticated chips. We're going to need to see that happen. Now, that does suggest there's a little bit of risk out there around that, and it's good we acknowledge, talk about, and identify that risk. But my sense here is that we're going to be in that 2.5% to 3% growth range next year. If things really happen, then we'll be above 3%. Those are good first world problems to have, Kristen.
They are very good. Indeed, Joe, what does that mean, or tell us perhaps about the broader picture, the international landscape, even for some of these emerging markets?
Okay, so the U.S. is going to outperform again. Now, this will be a number of years now where the U.S. is just in its own space compared to its peer G7 group. You know, policy tailwind, the growth in the interest rate differentials have created conditions whereby we've got an incredibly strong dollar right now. That's attracting capital into the United States like a magnet. If you took a look at capital flows through mid-year, capital flows into the U.S. were larger than the next 12 economies combined. Think about that for a second. Now that's good for us. We have investment needs. But in emerging market land, well, that may cause some issues. In economies that don't have adequate fiscal buffers, by that I mean Forex reserves to cover imports, should their currencies be devalued, we could see some problems among the emerging markets. The greater global economy, we're expecting growth around 2.3 to 2.5%. Well, that's good in the United States. That's a disappointment globally. It's because China's having a significant problem. India has actually slowed down unexpectedly, I think due to their overvalued currency, right? And then there's already adjustments going on in emerging markets. We'll have to wait and see how this plays out and if that creates stress in equity markets across the globe, and if that bleeds into the United States. And that's one of the risks ahead in 2025.
Joe, I also want to ask you about President Jimmy Carter, of course, dying at the age of 100, the longest living former U.S. president, passing away on Sunday. There's been a lot of talk about his legacy that he leaves behind and the life that he lived. Talk to us about the economy that Carter was grappling with while he was in office.
He quite simply had the most difficult economy since the Great Depression. He inherited an economy that was stuck in the throes of stagflation, economic stagnation, and incredibly high inflation. You know, we've just come out of a period where inflation went to 9%. This was nothing compared to what they dealt with. And he really drew a very bad hand in terms of that. And he suffered for it. That economy, I mean, I have to tell you, was a time where Americans' living standards were declining in real terms because of not just the slow growth, but slow wage growth, which was eaten away by that inflation. I mean, I was just a kid, and I can remember 1978 and the gasoline crisis and oil crisis that we had because of what was going on with the situation with the Middle East and Iran. My dad used to pull up to the gas station, and it may take an hour and a half to 2 hours, right? And I remember sitting in the Volkswagen thinking, what is this? It's hard to believe in the United States that things like that actually existed, and they did. And it gives us some perspective about where we're at and our very first world problems we have now compared to the hard and long structural adjustment that the United States economy went through. between really, the early 1970s and the early 1980s. I mean, if when we talk about lost decades, President Carter covered 4 of those years of that lost decade.
Such a remarkable legacy that he leaves behind, a life that he lived, including in poverty at one point, and a U.S. president that we will honor throughout the day here at the New York Stock Exchange. Joe Brusuelas with me in studio. He's a principal and chief economist at RSM US. Joe, always a pleasure, especially as we look to start 2025. Thank you.
Thank you.